Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, July 11th, 2017. I wanted to go over my commodities watch list. You can see a list here of about 18 commodity tracking ETFs that I'm following on this particular charting platform. Now I'll say this, and particularly when we talk on the first chart here, which is one of the natural gas tracking ETNs. When trading commodities, although I'll put up the commodity tracking ETNs, usually it's a trade ideas because the vast majority of investors, that's what they go after. And I always say if you are familiar and comfortable with futures, if you have a futures trading account, you have a margin account, you can trade the futures. You can trade these any way you want. And when trading these, even at times I'll trade futures, but at times I'll also take the ETNs. It just all depends on the particular trade. But I will always reconcile the charts of an ETN, particularly these commodity tracking ETNs, with the charts of the either the spot commodity or the spot commodity, as well as the continuous futures contract or the near month futures contract. So and again, in particular, when it comes to the natural gas and the oil tracking ETNs, there's a lot of slippage, decay. You have all types of things that affect, these guys, these ETNs that track natural gas, they'll use futures. And you have all types of stuff, contango, backwardization, all these other things, slippage, things that affect the price, and these things tend to track poorly over time. When you can just pull a chart of natural gas continuous contract or spot prices, and you'll see that. With that being said, traders, these are very actively traded. They're very popular. So often you'll see a bullish chart pattern on one of these charts, like GAZ right now. GAZ has this bullish divergent low. You can see the positive divergences, and it popped, it's up right now over 10%. It was higher than that earlier in the day. You see that large green candlestick. So you can trade off these, but my bullishness right now in natural gas is tempered somewhat because the charts of the continuous contract, the futures contracts, don't jive or don't mesh with this. And if you trade these, you guys know that these are very volatile. Here's gas, up double digits today. That cuts both ways. There's days it drops 10% or more, and if you're not comfortable with that, just stay away from these. If I see a compelling setup and again the futures contracts confirm the move, then I'll put these as official trade ideas. Once in a while I will, but you don't see these too often. But there it is. Here's your levels if you're in this one. It has resistance here around 35 or so where it stopped today. This little basing pattern here, potential basing pattern. If it clears that, it can run up to about the 40-cent level, and that's a decent move. 5 cents on 35 cents. That's about 15% or so. Just one to watch. And along that line, here's UNG. And again, this chart doesn't mesh too well right now with natural gas continuous contract. UNG, just like GAZ, recently made a new low, lower than the previous low. And if I'm not mistaken, that's not the case with the continuous contract futures. So, but it is a divergent low that we have here. So this chart definitely looks more bullish than bearish. And, the common theme I'm seeing among a lot of commodities is the risk reward, especially if you're a longer term investor or trader and you want to put something away in long-term accounts. You're not a very active trader. The risk reward, in my opinion, is, and I'm talking, over the next year or so, much more favorable on a lot of commodities and as well as precious metals than equities. Equities, as we all know, most of us probably know, we're very well into the second longest bull market in history of the U.S. financial markets. And soon, if that continues, we'll be in the longest bull market. Valuations are at levels only seen a few times in history, and each of those times is those instances where we had the Shiller P ratio and some of the valuation metrics this high. Those were followed by, some of the worst bear markets we had. As we all know, interest rates from this point, although they don't have to, continue to rise, they have been bumping up, and they have virtually nowhere to go but up from here. And, historically, a rising Fed, or, a rate hiking cycle, which the Fed has already embarked on, has been followed by declines in equity prices. So Enough. I don't want to get too much into the stock market, but again, asset allocation is key to investing as well as swing trading. So, consider commodities, one piece of the pie in your portfolio. And I do think, as I said in yesterday's post, it'll be a stock picker's market, quote unquote. As far as security selection, all commodities aren't equal. In fact, they have, natural gas has absolutely nothing to do with wheat, corn, or, cattle futures. So there's a lot of, I think it'll be, a selective market where we'll have opportunities to swing trade as we did in the grains recently. Other agricultural ETFs, oil, natural gas, silver, gold, industrial metals. We'll just have to play those each, look at each one and trade them off their own fundamentals and their own technicals. So here's UNG again if you want to replicate this. I'm not crazy about the downtrend line because we only have 2 reactions, but I do note this horizontal line here around the $7 level on UNG. You can see that it has actually contained prices in the past, acted as support when tested from above, or resistance when tested from below, most recently as well. So a pop above that $7 level should be bullish and could bring, should have no problem bringing it up to about $7.32, and that's a decent move, 32 cents on a $7 share price. And possibly up here I could move that line a little higher. But again, strap on, put on your seatbelt if you're trading natural gas. You're going to have to allow yourself wider stops, higher price targets to account for that higher loss potential, because these things, it's a volatile commodity. So let's move on. Enough on that. Soybeans. Talked on this one recently, put it up. We had this bullish falling wedge pattern with a divergent low. We had a divergent low here, another divergent low there. It's the second divergent low that did the trick. That's all it took. And that divergence has played out and then some for an explosive move. Soybeans have rocketed up in a near vertical ascent, about 13% since that divergent low in just a few weeks. Where they go from here, again, I put up a static chart on this yesterday on all the grains. And this one, they lump it into the grain ETF, even though I imagine soybeans technically aren't a grain. It is considered so, at least in the JJG, the grain ETF. So there's a little more upside there, potentially, based on this chart. But again, as I said, when putting these on as official trade ideas, I'll reconcile the charts with the future charts. And right now, although this one could come up, it's gotten quite stretched, and I'm not interested in reloading into soybeans unless they come back to this level. You can see this support zone, these 2 lines close together. That would be an objective long entry. You could put your stop somewhat below the bottom there. And if that level happens to give way, you have very good support, or I should say decent support here around that. We had a price targets back here from 2016, so around that 1850-ish level. But this would be my preferred scenario, this first one, a pullback there and then a continued advance. But keep in mind, with such a sharp advance, they also may need to consolidate for a while. So you can step in there, and it could be a dead money trade. So for swing trading, again, I need to look at the daily charts on both the ETNs as well as the futures contracts, and I like to see the 60-minute charts confirm a swing trade so we don't get caught in a dead money trade even if that support level holds. All right, next one up is CUT. CUT is one of 2 timber ETFs that I follow. These are actual ETFs. Meaning I believe they hold, if I'm not mistaken, timber companies that are in the business of producing timber. So I don't think it actually holds timber futures. I actually take that back. Timber, I don't believe, trades any futures contracts, if I'm not mistaken. I think it's a one commodity that they don't have futures contracts. I could be wrong on that, but either way, these are ETFs, and they're chock full of something, and all that matters is what the charts tell us. There's a very well-defined uptrend line in CUT. You can see it's forming this, prices are tightening. This is giving it that wedge-shaped pattern or appearance, negative divergence. You can see it a little better if I lift this up. We had such a high peak on the PPO back here. That divergence is steepening there on the RSI. So this is really what we need to see, a break of this uptrend line, and that would bring us back to any or all of these targets. And my minimum target right there is about 2680, and then 2575 if that one gives way. However, we need to see wood also follow suit. Wood's already broken down. Wood had a whipsaw breakdown here. The trend line's not as well defined, but you can see these charts look very similar. So I'm watching both of these. And what I think will be the catalyst for reversal in timber is a top, or at least a significant correction in both the equity market, but more importantly, the home builders. And I think that's all related. You know, real estate market has gone up with the stock market. It went down with it in 2008, 2009. It's coming up with it now. Has been coming up with it since. So once the brakes really get put on this market, especially with the home building, you know, I've read articles that, you know, are comparing this bubble right now in real estate. Some areas are so frothy, speculation's back. They're comparing it to 2007, you know, when the market topped. So, and obviously, you guys know that, you know, most homes, or all homes, to some extent or another, you know, have a lot of demand for timber and wood. So therefore, this chart will jive with the housing market, and you can see this one's already cracked. Cut is there, and that's, you know, that's a pretty significant downside if it plays out. Even to that first target, we're talking about a 7% drop. If it gets down there, about a 10% drop. So there's one. And again, this speaks to the fact that all commodities are, you know, have their own independent charts, our own independent fundamentals that come into play. Coal miners ETF. It's on a sideways trend. I won't spend too much time. You can see we had a bearish rising wedge. It broke down. It was good for a decent correction. Doesn't look like much on this chart. I use log scaling, but it was a decent correction, especially from the highs. And it's just floundered around in this sideways trading range for a while. So my opinion is not very strong. If it breaks down below, that would be bearish, obviously. And if it takes out the previous reaction highs, that would be bullish. But again, not what I'm interested in engaging right now, that sector. JJG, this is JJC, I'm sorry, this is the copper ETN. You can see a downtrend line here. We broke above it. That's bullish. So copper's looking pretty good. You know, they used to call it Dr. Copper. Did such a good job of gauging the health of the economy, but that it was stripped of that title years ago, and you know, it's driven by other factors in recent years. So it's possible to see, you know, the market or the economy turn soft and copper continue. But I don't have a very strong opinion on this chart, to be honest with you. I just point out that downtrend line. So let's just move away from JJG. Spend time on the ones that I'm liking. UGA, this is a gasoline ETF. So it holds gasoline instead of oil, refined gasoline. And, you know, it looks like a divergent low here, but that's bullish. I'm not so crazy about the chart of gasoline futures. So I'm gonna say I'm more bullish than I am bearish on this one. Just like oil, it's at or near the low end of its historical range. And like I said, you're gonna, you know, there's not a set bottom in oil or gas prices, but there's a relative bottom or a bottom range, and we're at that range. So maybe dead money. Maybe we come back and visit the lows back in 2016, possibly even take them out. But what we can watch here is this downtrend line. We see a downtrend line forming. So let's look for a break above that downtrend line, and if it confirms on futures and everything else, maybe that one will be a long side trade. Again, I'm sort of just watching the oil and energy and gas sector. Oh, before I leave that, well, I'm coming up to USO in a minute. I'll get to USO in a second, and the other ETN oil, OIL. But I'm going through these in order. So here's wheat, again, covered yesterday on the front page. This was a recent trade idea. We hit all three targets, you know, breakout in a nice, you know, near vertical advance. But it's given up a little bit. You can see it came within just basis points of my potential long-term target. And, you know, these commodity tracking ETNs don't always do a perfect job. I'd have to look again at the chart of the wheat continuous contract, the future contracts, and let you know my thoughts. But what I'm getting at, that may have been a essential hit of that long-term target. And as I said yesterday, whether it has one last thrust up to there, if it does, I expect it to find resistance around that level, but it may have already tagged that level. And the risk reward right now is not very favorable, especially to enter a long position. If you're already long, you want to tuck this one away long term. If you're looking out for the next year or so, willing to ride out pullbacks, great. If not, if you're swing trading, this is where I'd look to buy. You have a gap right here, but I'm more interested in this support level here around 770. I think that's a very objective level to go long. You can see the previous reaction high. That's also right around where my final target was hit back then, or third target, I should say. We had support there, so that's a pretty decent level, and I could see something like that. And again, longer term bullish. Near term, I would say I'm mildly bearish because I think it's run up enough and probably has to pull back or consolidate for a while. Intermediate term, hard to say if we consolidate for a while. That's the most probable scenario. I don't see us breaking above the 850 level and running anytime soon, although anything is possible with commodities. Corn, again, covered yesterday in the grains. There it is. There's the first target that was hit yesterday. It's pretty significant resistance. You can see all the reactions here, reaction from above back there, reactions. So it needs to take out that $20 level, and then the next target's here around 2070 or so. It's certainly forming a nice basing pattern. You can see, corn prices are pretty much based in this range here for going on a year now, and that's powerful long term, because if and when we break above that base, corn has quite a ways to go to look at where it was back here, and this is again just the ETF with all its tracking error and all that. If it gets back to anywhere where it was back in 2012, you're looking at an advance of about 170% to get there. So long term, I like it. It looks like it's basing. I see bullish divergence here, and it just needs to, in the near term, needs to bust above that $20 level, and it's already, it was quite a stretch to get there, so that's why I favor a little pullback before it breaks above, but anything is possible. You saw it on JJG, you saw it on SOYB, WEAT, you saw these strong advances, so just respect a breakout. All right, USO. Okay, here's oil. I feel a lot of questions on oil, my thoughts. Now, going off USO, since it's a ETN, it's a limited partnership, it's trying to track, but it doesn't do a great job because all those things you come into play when trying to trade futures that I mentioned earlier, you're going to have a lot of tracking error. I looked at WTIC, West Texas Intermediate Crude. Again, if I had to be long or short, I'd rather be long oil here, but I'm not crazy about it. My conviction is not strong enough to go long. I think it's still trying to pound out a bottom. However, with that being said, the energy stocks are looking interesting. I did in recent months, I've covered quite a bit on the S&P 500, the various sectors within there, and energy is one of those. It makes up about a 6% weighting in the S&P 500, and for a while I've stated the next buy signal will come on a break of this downtrend line. That was, I think, all the way back here. We went up, we hit it, maybe it was here. And I also said, so the two areas that are objective longs would be a break above the downtrend line, which we've yet to do. And look how well-defined, very well-defined downtrend line. Or a move down to this 63.90-ish level, and that's what we've done. We recently went down there. We've actually hit it quite a bit recently and have held that level. That's an intraday spike. You see the candlestick shadow or tail, but we closed right back above there. So it's really respecting that level. And I had mentioned that weeks ago, if not months ago, that would be a possible buy point. There's potential divergence there. I haven't stepped in yet. I'm watching closely. I'm also looking at individual names. I've gone through the energy stocks, both the major integrated oil companies like Chevron, ExxonMobil, as well as the exploration and production stocks. So I'll try to get any individual trade ideas out, or an ETF. I know some of you guys prefer ETFs, but I'm still just not. There's something that is giving me pause right now, even though XLE is trading at support. I'm just not crazy about some of the things I'm seeing. So who knows? Maybe within the next week or so, I start floating some ideas out there, maybe even unofficial trade ideas. But when I think the time is right, we'll engage the energy sector just as we did back here. We had some great trades back in early 2016 on a lot of those stocks. All right, next up would be DBA, which is the Power Shares Agricultural Fund ETF. Looks good. You can see here a series of divergent highs. You look down on the PPO down here, divergent high number 1 right here. We had a bullish falling wedge. Boom, there was a trade. Nice swing trade. Divergent high number 2, we had this descending price channel. We had a divergent high right here, and boom, prices exploded. And that was good for, these are all decent runs, in DBA, about 5.5% or so. And most recently, right here, we had a third consecutive divergent high. These are all really an extension of the previous divergent highs, with DBA making newer lows, and boom, another nice rally off the lows, good for about a 7% gain so far. So this looks to be one that's shaping up. You can swing trade it here, but I also think it's setting up. I think that these are close to a bottom, and the potential, you go back, look at a weekly chart, you can see the weekly chart, you can see these divergences. I'll extend them out. We had a divergent low there where I just had it marked, and that played out for a nice rip. Now we have even larger, more powerful divergences. So this looks like an area that's bottoming. And again, I think on the long side, over the next year or so, year or two, the risk reward is much more attractive here in the agricultural commodities than it is in the equities in the stock market. JJG, there it is, covered it yesterday. The grains ETN breakout backtest, boom, didn't look back. Getting a little stretched. Here's that previous reaction high. We had punched above it yesterday when I made that post, but now look, we've fallen back down right about on there, right below it. So that's what I call a momentum fueled overshoot. The fact we popped above that reaction high without anything. We got close to it, then gapped above it, but look, we've given all that back now. And so that momentum fueled overshoot is complete now. So we're basically at resistance. And that's where if you took this one, you didn't book profits. Again, it's only down 0.13% today. It's another chance to exit. And if you're a longer-term investor, just raise your stops to protect profits. And if you're looking to buy back into this one or enter long if you didn't take it yet, I could see an ideal scenario. Any of these lines that I have on my chart are support levels, any of which could produce a reaction. But it would be really nice to see it come back down here to that 29.50 area. That would be a nice objective entry. We might not get that. We don't always get what we want. So maybe a partial position there around the $30 level and then add on at the $29.50 level if it gets there with a stop somewhat below. Oil. Oil is really very close to the USO. This is another oil tracking ETN. Looks, based on this chart, looks okay. Like I said, bullish divergences in place. There's not crazy about that downtrend line because I only have 2 reactions so far. So I wouldn't go crazy on a break above that downtrend line. But here's here's another commodity tracking ETN that looks to be right around its early 2016 lows. So I think it's safe to say oil's trying to pound out a bottom here. We just don't have evidence of it yet. If you look back for the last year, actually year and a half, it's been a dead money trade. There's a big range from top to bottom, but longer term picture, we look at a weekly chart. There it is. See, you can see this. And this is why I've, other than 2016, we had a lot of trade ideas on the site. Hit them aggressively, got in, got out, got that initial rip, and for the most part, I've just sidestepped this mess. And it's because the charts just weren't clear. And I'm glad I did. You don't want to get as a swing trader or an investor who wants to get tied up in a sideways range like this. Trend traders, swing traders, you want to trade trends. That's a trend. This is not a trend. Now, you get into the world of the 60-minute charts and the daily charts, you can trade, or the intraday charts, you can trade these rips and dips. But it takes a lot of effort and focus, and my focus just hasn't been there in the energy sector lately. Plus, that's a sector that's manipulated so much. The technicals can be destroyed a lot because the Saudis, any oil-producing countries can come back online real quick. Their comments spark rallies and all that. So it's really a tough sector to trade in and out day to day. So I just wait for the very clear setups and the big moves. Cow, excuse me. A cow is the UBS livestock total return index, so aptly named. This one, for example, if you'll note, we saw that recent strong rip in the grain ETFs, and you can see this pullback here. Now, that wasn't coincidence. I think I put this one up in recent months. We had a resistance level here, and we hit that resistance level that I had recently. Pulled back from there, and that about coincided with that rip in grains. Grains are one of the biggest inputs or costs, to livestock. You got to feed them. And so if grain prices continue to rise in the coming years, if grain prices have bottomed, then that could give some headwinds to, livestock prices. You can also see the negative divergences here in place at the highs and all that. So watching this trend line here, that uptrend line, looks like we may have broken down below it, but yeah, just not feeling it right now for a short. Maybe I'll have to look at the futures, to be honest with you. That's what I'll do. And if it goes below there, if you are interested in this one, there's some support right there around 2409. So break above that, below that level will probably take us back here to at least the 23 level. So maybe a trade there for you. JO, this is coffee, the coffee ETN. Nice divergent low. I think we did have this one recently as a trade. It was a stop clearing textbook stop rate on that one. You can see, I think I took my stop off here. I had it somewhere around here, and that big red candle took out the stop, if I'm not mistaken, and that was followed by a huge green candle, big green candle the next day, and a rally up. That's a stop run. That's very bullish. When you see that, it took me out. Took probably some of you out on the site that took the trade, but that's what that does. It changes the supply dynamics, the supply and demand dynamics. I'm sorry, within coffee. Whether I'm sure the same thing occurred in the futures as well. And what it does, it washes out the weak hands, people that have been long coffee, especially investors, longer term traders. And it ushers in a new set of buyers and sellers. So it's sometimes very bullish. We saw the same thing in GDX, if you guys recall back in, I think it was early 2016. Same kind of, we had a very well-defined support level. They ran GDX down, and then boom, we had the huge rally that followed. So there's a minor downtrend line that was taken out. This was resistance, was support here, broke, then became resistance. We cleared it, and we're dancing on that level now. We might be slightly below it, but I think coffee will continue to work its way up and go on to hit any or all of my targets that I had from the previous trade. You can see this nice divergence, a bullish divergence at that low. Objective levels, I'll have to get into it later, guys. I'll have to look at the futures chart, and I may put that one back as an official trade. Here's another one. They clipped our stops. I tried to, I was watching sugar SGG last week. I noted a bull flag formation here. It's not drawn on this particular chart. We broke above it. It looked like the real deal. Came back in, and in hindsight, the fact we didn't have follow-through impulsive moves, this is when I was traveling on vacation. I thought I would miss that one. Came back, tried to buy it on a back test of the flag, but that just proved to be more follow through. The breakout failed of the flag. However, this one's still looking like it may be bottoming, but I'll tell you what, we had divergence back here. We don't anymore. We do on the RSI. I'm watching it closely. I'm watching it for a reentry. This was a nice support level here. You can see reactions. We're now back down below it, and that's part of the reason where that stop was placed. The stop was placed both on a, relative to the risk-reward ratio to the third target, as well as that, you can see all the tags there around that level. So that was, the stop was strategically placed below that support line. We busted through it, so I have no position in SGG now, and I'll update that on the site as soon as possible. I made mention in the comment section this morning it was stopped out. There's NIB, Cocoa, another one that looks like it's bottoming. We took it for a nice trade there and hit the second target and then fell, put in another divergent low and bounced. So, it's a thing of wash, rinse, repeat. The bottom hasn't been put in these yet, but these swing trades are certainly there. Look for these divergent lows. We had one there. We had one here. You can see it down on the RSI and the PPO. We have another potential divergent low. Now, the PPO is pointed lower. It just made a bearish cross. It's heading lower. So if I had to guess what's going to happen here, I don't think this support level will hold. I think we'll have another washout move in here like we did in coffee. And let me draw it out for you. This would be my preferred scenario to see that flush out move. Let's break this support. You can see numerous reactions here on that line, that support line. A little washout move down there, followed by a reversal. And so where to go long if you get that flush out move? Well, you can, if you're aggressive, you can step in if it drops down to the 20, maybe 2050 level. It's hard to say where the bottom will be, but the more conventional entry would be to wait to see a bullish, some type of bullish candle reversal pattern. So you see look for a possible selling climax, then a big green candle, and most importantly, a move back above this level here around the 2140-ish level, especially a daily close back above that level after a breakdown below would be bullish. Now, if the level holds, great. It holds. These charts will continue to firm up. You'll see the PPO cross back above, make a bullish crossover. That's certainly a possibility. But like I said, my preferred scenario is that washout move. And that would bring us down here, keep that divergence intact, a little bit lower on the RSI. And that would bring us up. My minimum swing target right there would be around that 2563-ish level. Give or take. And again, like everything else, this one has the potential for longer term gains too. That's it. All right, this has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.